Hello friends, today we will discuss about cash flow statement. It is prepared under Accounting Standard 3 and Ind AS 7. So let's begin. It is possible for a firm to be highly profitable but not able to pay dividends. It is possible for a firm to be highly profitable but not able to invest in new machineries. It is possible for a firm to be highly profitable but not able to pay interest on time. It is possible for a firm to be highly profitable but not be able to pay salaries on time. It is possible for a firm to be highly profitable but not able to pay to creditors. And it is possible for a firm to be highly profitable but go bankrupt. It means in number of time it happens that as per the profit and loss account, it is showing good amount of profit, but the business is having liquidity crisis. There are many reasons for these type of situations. Number one, over purchasing of inventory. Number two, money stuck with account receivables. Number three, and in case of banks and financial institutions, the loan borrowers are not paying installments on time. So what happens with these scenarios? We understood that cash flow is not the same as profit. Profit is a result of subtracting expenses from sales, whereas cash flow results from the difference between actual cash receipts and actual cash payments. Cash flows only when actual payments are received or made. Sales may not be regarded as cash because a sale may be incurred but payment may not be made for 30 days. In addition, not all bills are paid immediately. On the other hand, cash payments to reduce the principal on a loan do not constitute a business expense but do constitute a reduction of cash. Also, depreciation on capital asset is an expense which reduces profits, not a cash outlay. Now we will discuss the meaning of cash flow statement. So cash flow statement is a statement that shows inflow and outflow of cash and cash equivalents during the period under report. Period may be 1 year, 6 months, 3 months, 1 month, 1 week, etc. Now, why we are making cash flow statement? The objectives of cash flow statements are: it is used as the short-term financial planning of the business. Cash flow helps in assessing liquidity and solvency position of the business, whether the company is able to pay its short-term as well as long-term obligations on time or not. Cash flow statement helps in the efficient cash management. It is used for comparative study of the cash flow of the company in different time periods. It is used to take the dividend decision as cash is needed at the time of payment of dividend. Now we will discuss about cash and cash equivalents. So cash equivalents are short-term, highly liquid investments that are readily convertible into known amount of cash and which are subject to an insignificant risk of change in value. Like for example, cash in hand, cash at bank, demand draft, checks in hand, marketable securities having maturities of less than 3 months are included in cash and cash equivalents. Now you will say that we can convert our machine, plant, etc. also into cash within 3 months. But if you convert your machine, plants into cash, then your productivity will suffer. Or suppose you have some investments in the equity shares of TCS and you are planning to sell these shares after 2 months. But these equity shares will not be included in cash and cash equivalents because there is a risk of downfall in the value of the shares at the time of sale. So equity shares, mutual fund, derivatives are not included in cash and cash equivalents. There are some non-cash transactions also. Non-cash transaction means those transactions in which there is neither cash inflow nor cash outflow. For example, conversion of debentures into equity shares, there is no cash flow. Conversion of preference shares into equity shares, there is no cash flow. Issue of bonus shares, no cash flow. Splitting shares of higher face value to lower face value, no cash flow. Acquisition of assets by issuing debentures or shares, no cash flow. Acquisition of another enterprise by issue of shares, no cash flow. Depreciation or amortization, no cash flow. Reserve and provisions, no cash flow. So non-cash items are not shown in the cash flow statements. Now, types of activities. In the cash flow statement is divided into three types of activities. Number one, operating activity. Number two, investing activity. Number three, financing activity. So we will discuss one by one. Operating activity. Cash flows from operating activities are primarily derived from the principal revenue generating activities of the business. So they generally result from the transactions that enter into the determination of profit or loss. Example of cash flow from operating activities are as follows. In case of cash inflows, examples are cash sales, cash received from accounts receivables, cash received as commission or fees, royalty received, refund of tax. In case of cash outflow, examples are cash purchases, payment to accounts payables, payment to operating expenses like salary, wages, rent, audit fees, etc., payment of taxes, like this. Second is the investing activity. Investing activities are the acquisition and disposal of the fixed assets and long-term investments. Examples of cash inflows are proceeds from sale of investments, proceeds from sale of fixed assets, interest received, dividend received, etc. And examples of cash outflows are payment for purchase of fixed assets and payment for purchase of investments. Third activity is financing activity. Example of financing activities are cash flows, proceeds from issue of equity shares or preference shares for cash, proceeds from issue of debentures for cash, proceeds from long-term borrowings, bank loan taken. Cash outflow examples are payment for buyback of equity shares, payment for redemption of preference shares or debentures, payment of loan, payment of interest, payment of dividend. There are two ways to prepare cash flow statement. Number one, direct method, and number two, indirect method. The format of cash flow statement as per direct method is like this, which you can see in the slide. First we prepare operating activity, then investing activity, and then financing activity. While preparing cash flow statement, we take the data of 2 years so that we can compare the data of the 2 years. Now, let's take the example of Lehman Brothers to understand the importance of cash flow statement. Lehman Brothers Holding Corporation was started in the year 1850 and it got bankrupt in 2008. At the time of bankruptcy, its assets were 639 billion while debt were only 619 billion. It means their assets were more than their liabilities, but still bank went insolvent. As per the income statement, the profits of the bank were continuously increasing from year 2005 to 2007, but still the bank was in financial crisis. The reason is loan borrowers were not paying their installments on time, while depositors are regularly coming to bank to withdraw their money. So financial crisis started in the bank. You can also see that the cash flow from operating activity is showing negative balance every year, which means bank was not able to convert their accounting profit into the cash profits. And to pay their operating expenses, bank was raising money from external sources. That's why its financing activity is showing positive balance every year. So as a conclusion, to be survive in the long run, operating activity should always be positive. That's all from my side. Hope you like the video. Thanks for watching. Take care and have a nice day. Thank you.